Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at the Global X Defense Tech ETF.
If you find our talks useful, please consider subscribe, like, and comment underneath. Today, we're really looking at a massive fundamental shift in how global security is funded.
Right, exactly.
And more importantly, for you listening, how that capital is physically reshaping your potential market investments. Because the narrative globally has decisively shifted from, basic threat perception into active conflict.
Yeah, but before we dive into the actual dollars and cents, I think we need to set a really firm boundary for today's analysis.
Good point.
Because the data and the market movements we're looking at, they touch heavily on the ongoing U.S.-Iran conflict that began on February 28th, 2026.
Right.
And we take absolutely no political stance on the conflict itself.
Oh.
Our discussion today is strictly an objective analysis of the factual economic and market impacts resulting from these global events.
Exactly. I mean, when you're building wealth, separating the geopolitical reality from your emotional response is just paramount.
It really is.
So let's look at the sheer volume of capital entering this space, because you just can't understand the Global X Defense Tech ETF without, first grasping the macro picture.
And the numbers we are seeing are just staggering.
They really are. I mean, in 2024, global military spending hit $2.7 trillion. Trillion with a T. That is the highest pace of growth the world has seen since the end of the Cold War. And here in the U.S., the defense budget is rapidly tracking toward that $1 trillion mark.
Which is wild, because we are hitting that threshold nearly 5 years ahead of prior congressional projections.
Yeah, 5 years early. And it's not just here, right?
No, not at all. You also have to factor in the massive shift happening across the Atlantic. European allies are they're currently mobilizing 800 billion euros in defense investments.
Wow.
And that's targeted for 2030. That capital is being deployed specifically to reduce their historical reliance on U.S. security infrastructure.
Because, if you look at the 1990s and early 2000s, Western nations were essentially enjoying this peace dividend, right?
Exactly. They were systematically shrinking defense spending as a percentage of their overall GDP. But the market data we're looking at today indicates that era is definitively over.
Yeah, the way I look at this shift in spending, it's it's the difference between buying a home security system because you read a neighborhood watch flyer versus buying one because someone is actively kicking in your front door.
That's a great way to put it.
Right. The urgency completely changes the budget. You stop looking for the cheapest option and you start paying for immediate, overwhelming reliability.
And the structural term analysts use for that kicked-in-door scenario is a supercycle.
A supercycle.
Yeah. When market data points to a supercycle, it doesn't mean a quarterly spike or, a temporary boost in government spending just to restock some ammunition.
So what is it, fundamentally?
It represents a structural fiscal reversal. Governments are not just buying replacements for old legacy equipment. They're tearing down and overhauling their entire security apparatus.
So for long-term investors, this signifies a multi-year, possibly multi-decade runway of sustained capital deployment.
Exactly.
And with over $1 trillion in play just in the U.S. alone, that money doesn't just evaporate into the ether. It lands on corporate balance sheets.
Right, it goes somewhere.
So we need to shift from these massive macro budgets to the specific companies inside the Global X Defense Tech ETF that are actively absorbing this capital.
Let's look closely at Lockheed Martin, which is a major anchor holding here.
Okay, let's talk Lockheed.
Right now, they are sitting on a staggering $194 billion backlog.
Wait, $194 billion?
Yes. To put that in perspective, that backlog is roughly 2.5 times their total annual revenue.
That is just massive.
It is.
Yeah.
And their ability to generate actual cash from their operations is equally critical. In 2025, they generated $6.9 billion in free cash flow.
Which is a vital metric for wealth building, right? Free cash flow is the cash a company produces after accounting for all the cash outflows to support operations and maintain capital assets.
Exactly. It is the money left over that can actually be used to pay dividends or buy back stock or reinvest in high-tech R&D.
And we just saw a massive catalyst for them, didn't we? End of March.
Yeah, March 25, 2026. They signed a framework agreement to quadruple the production capacity of precision strike missiles.
Quadruple.
Right. And that agreement builds directly on top of a $4.94 billion Army contract.
Wow. But we also have to look at the international side of the ETF, which captures that European spending surge you mentioned earlier.
Right. You have a key European holding like Leonardo.
Right. They recorded 17.8 billion euros in 2024 revenue.
But the more important metric moving forward is their new orders, which hit 20.9 billion euros.
Which means, in industry terms, that creates a book-to-bill ratio of over 1.0.
And that book-to-bill ratio is the ultimate leading indicator of expansion in the defense and manufacturing sectors.
Can you break that down real quick?
Sure. If a company has a ratio of exactly 1.0, they are bringing in one new order for every one order they ship out and bill for.
Okay, that makes sense.
So when you push past 1.0, like Leonardo is doing right now, it means the business is actively expanding faster than it can currently produce. They're actually maintaining 2.5 billion euros in annual research and development just to stay ahead of that demand curve.
Wait, I have to play devil's advocate here.
Go for it.
$194 billion backlog at Lockheed, or 20 billion euros in new orders at Leonardo. That sounds incredible in a press release. But for an investor, isn't a backlog essentially just a giant mountain of government IOUs?
That's a fair question.
Because we all know how notoriously slow the Pentagon and European defense ministries move. How does a theoretical multi-billion-dollar backlog actually turn into real, tangible revenue that impacts a stock price in a time frame that matters to an investor?
So historically, you'd be totally right. Converting a defense backlog into realized cash flow was indeed a slow, bureaucratic grind.
Yeah, it takes forever.
It could take years to move from contract award to final delivery. But the physics of that pipeline have completely changed due to the ongoing Middle East tensions.
Specifically, the events since late February.
Exactly. The global security apparatus is currently in the middle of a missile defense supercycle.
Yeah.
Active conflicts are consuming stockpiles of systems like THAAD and PAC-3 interceptors at unprecedented rates.
Let's define those for the listener, because we hear those acronyms on the news all the time. THAAD stands for Terminal High Altitude Area Defense.
Right.
And PAC-3 refers to the Patriot Advanced Capability Interceptors. These aren't your standard run-of-the-mill munitions.
Not at all.
These are highly complex, multi-million-dollar radar-guided missile defense shields. They're the systems you see intercepting incoming ballistic threats in the sky over active conflict zones.
Exactly. When those highly advanced multi-million-dollar assets are being fired off daily, the government forces a rapid replenishment cycle.
So bureaucracy gets sidelined.
Entirely sidelined by sheer necessity. That geopolitical urgency acts as an accelerant, streamlining the production approvals and testing phases.
So it converts that massive backlog of IOUs into realized cash flows significantly faster than traditional peacetime historical models would ever predict.
We got it.
Okay, but if there is this much cash flowing, literally hundreds of billions of dollars, with fast-tracked contracts and sidelined bureaucracy logic says Silicon Valley should just be all over this.
You would think so.
Right. Why wouldn't a syndicate of tech billionaires just pivot their AI startups, flood the zone, and steal these lucrative contracts right out from under the legacy defense primes?
Because the defense technology sector operates behind arguably the highest barriers to entry of any industry on Earth.
It's a moat.
A massive moat. The market is currently paying a premium for the Global X Defense Tech ETF specifically, a price-to-earnings ratio of 41.34, because institutional investors recognize that this competitive moat is virtually unassailable for a newcomer.
Let's break down that price-to-earnings, or PE ratio, of 41.34. A PE ratio essentially tells you how much investors are willing to pay for $1 of a company's earnings.
Right.
A multiple of 41 is a massive premium. For context, legacy metal-bending defense contractors, the companies just making traditional trucks or unguided artillery, they usually trade at a much lower multiple, often in the mid-teens.
Exactly. Investors are paying 41 times earnings here because they are buying a fortress.
And that fortress moat is built on 3 distinct pillars. Right?
Yeah, 3 pillars. The first pillar is purely regulatory. Simply becoming a prime contractor requires multi-year clearance and certification processes.
So you can't just incorporate and start bidding.
No way. The company must possess physical infrastructure and data networks that meet stringent Department of Defense security standards before they are even legally allowed to bid on the hardware.
Right. I mean, you can't exactly build a hypersonic missile in your garage, slap a trendy AI logo on it, and pitch it to the Pentagon tomorrow.
Exactly. Which brings us to the second pillar, technological intellectual property.
The IP.
Right. The companies held within this ETF possess decades of highly classified, specialized R&D, We're talking about advancements in hypersonics, directed energy weapons like high-powered lasers, and AI-enabled command systems.
So a well-funded Silicon Valley startup just cannot simply code their way past 40 years of classified aerospace engineering.
They really can't. And the third pillar is the exact geopolitical urgency we see playing out right now.
Because they need it yesterday.
Right. When a combatant command has an immediate life-or-death demand for autonomous systems or counter-drone technology to deploy in an active theater of conflict, there is zero time to beta test unproven tech from a startup.
Governments default entirely to the prime contractors they know have the manufacturing base to deliver at scale immediately.
Exactly.
So you aren't just buying legacy defense contractors, you are buying highly protected, monopolistic exposure to high-growth tech subsectors, like cybersecurity and autonomous systems, all wrapped in guaranteed government contracts.
That's the fundamental thesis, yeah.
Okay, that explains the thesis. But let's look at the actual trading reality of the ETF. Because the fundamentals and the moats sound ironclad, but Wall Street isn't always rational.
Rarely rational in the short term.
Right. We saw the ETF surge 16.7% year-to-date through mid-March 2026.
That was a textbook breakout.
But recently, we've seen these de-escalation hopes hitting the news wires, and it triggered an immediate sell the news dynamic. The ETF entered a consolidation phase, and the price pulled back.
The pullback really highlights the psychological difference between short-term algorithmic trading and long-term wealth building.
How so?
Well, when you look at the mechanics of conflict breakout charts, the moment conflict ignites, the market instantly prices in the absolute worst-case scenario, prolonged escalating hostility.
And that initial shock is what drove that rapid 16.7% surge.
Exactly.
But algorithms and short-term speculators don't hold positions for years.
No, they don't. As the initial shock wears off, the market has to grapple with pricing in a drawn-out, grinding conflict versus the possibility of a sudden diplomatic de-escalation.
So when rumors of peace or ceasefire circulate, those short-term traders just take their 15% profits and run.
Right. That profit-taking is what causes the sell the news pullback, creating a temporary dislocation between the long-term fundamentals of the supercycle and the short-term chart psychology.
But in the midst of that short-term volatility, institutional flow is doing something really highly revealing. Analysts at major banks are actively recommending what they call a barbell investment strategy.
Yes, this is fascinating.
It really is. Institutions are buying defense tech ETFs as their primary pro-AI play. They view defense technology as the ultimate practical government-funded application of artificial intelligence.
Right.
But to balance that risk, they pair it on the other side of the barbell with investments in spirits and vintners like alcohol companies as their anti-AI hedge.
It sounds crazy at first, doesn't it?
It does. I want to spend a moment on this because the barbell strategy is just a fascinating window into institutional sociology. Why spirits and vintners as an anti-AI hedge?
Because alcohol is deeply human.
Right. It's tactile, and it's completely immune to technological disruption. Artificial intelligence can optimize a supply chain, and it can certainly guide a missile, but AI cannot code a 12-year-old single malt scotch.
It cannot replicate the human experience of sharing a bottle of wine.
Exactly. So by pairing defense tech with spirits, smart money is telling us they view defense tech not just as a geopolitical necessity, but as the bleeding edge of the AI revolution, which needs to be hedged against human physical realities.
That's spot on. And for an investor focused on actual wealth building rather than day trading, the consolidation phases caused by those de-escalation rumors often create strategic re-entry opportunities.
Because the fundamentals haven't changed.
Exactly. The fundamental thesis. The $194 billion backlog, the $1 trillion spending supercycle, the unassailable technological moat. It doesn't just evaporate simply because a momentum trader decided to lock in a gain based on a news headline.
Okay, let's stress test this entire thesis. Every great bullish narrative has a catch, and we need to look hard at the downside risks, the bear case.
Let's do it.
Risk number one is rapid de-escalation. We just talked about that 41.34 PE premium, which is a multiple built on the assumption of a prolonged conflict.
Right.
Risk number two is that the valuation premium falters entirely if the technology growth narrative stalls out. I mean, if peace breaks out tomorrow, which is obviously what every sane human being wants, doesn't a 41 PE ratio completely crater?
It's a huge concern.
How does an investor protect their wealth if the core catalyst, the conflict itself, ends abruptly.
That is the single most critical risk to address when allocating capital here.
Yeah.
Let's assume the absolute best-case scenario for humanity. Hostilities cease tomorrow, all parties go to the negotiating table, and a lasting peace is signed. Does the defense tech market collapse? The institutional data suggests it does not.
Why not?
The reason is that severe capability gaps have already been globally exposed. The events of the last few years, and particularly the intense engagement since late February, have demonstrated to every military command on Earth that their multi-billion-dollar legacy defense systems are incredibly vulnerable.
Vulnerable to what, exactly?
Cheap asymmetric drone swarms and advanced hypersonic technologies.
It goes back to the home security analogy.
Exactly.
The neighborhood watch flyer has been read, the door has been kicked in, and the homeowner realizes the expensive deadbolts they bought 10 years ago are completely useless against a modern threat. You just cannot unsee that vulnerability once it is exposed on the world stage.
Governments operate on extreme risk aversion regarding national security. Even in a state of absolute peacetime, defense ministries will spend the next decade buying the counter-drone technology, the autonomous defense platforms, and the AI-driven command systems required to ensure those exposed capability gaps are never exploited again.
And fixing those gaps isn't an overnight software patch, right?
No, not at all.
The procurement cycles required to design, test, manufacture, and deploy these new defensive systems take 5 to 10 years.
Exactly. That extended timeline provides immense revenue visibility for the companies inside this ETF.
So the structural shift has already happened. The hardware might stop firing on the battlefield, but the software, the sensors, and the deterrent systems still need to be upgraded globally.
And that revenue visibility requires a specific strategic horizon from you, the investor.
What's the target?
The target horizon for an allocation in the Global X Defense Tech ETF is realistically a 12 to 24-month hold.
So this is not a get-rich-quick swing trade.
No. You need that 12 to 24-month runway because you're waiting for the bureaucratic engine to turn those massive order backlogs into recorded quarterly revenue. And you need to be able to stomach the geopolitical headline volatility along the way.
For the listener actively tracking this space, the actual catalyst calendar is very clear over the next few months. We are looking closely at the April 2026 earnings season.
Yes, that will be huge.
That is where we will get crucial, hard data updates on those massive backlogs from prime contractors like Lockheed Martin and Leonardo.
And following that, in Q2 2026, we have the U.S. congressional budget discussions.
Right, which will officially cement the fiscal runway for that trillion-dollar spending package.
Utilizing an ETF structure for this specific supercycle offers a targeted, diversified vehicle. It effectively strips away the single company execution risk, the danger that one specific contractor fails a major weapons test or loses a bid, while keeping your capital fully exposed to the fastest-growing technological segment of the modern defense industrial base.
It really is a masterclass in how macro global events translate into granular market mechanics. We've traced the path from a $2.7 trillion global spending spree down into the $194 billion backlog of a single prime contractor and explored the regulatory and technological fortress moat that protects that cash flow.
We covered a lot of ground today.
We really did. But I want to leave you with one final provocative thought to mull over, building directly on that AI integration we discussed with the institutional barbell strategy.
Okay.
If artificial intelligence is truly becoming the new battlefield, as so many analysts and military strategists suggest, how long until the most valuable defense contractors in the world aren't the companies bending the metal and building the physical missiles, but rather the ones writing the code that controls them?
That is the multi-billion-dollar question that will define the defense sector for the next decade.
Definitely something to keep in mind as we head into those highly anticipated April earnings reports. Keep an eye on how those backlogs are evolving and converting to cash. Thank you so much for joining us, and we'll catch you next time.